Hello, everyone. Thank you for coming. Can you hear me? We okay? So my name is Harpal Sandhu. I'm chairman of Mint Exchange. So by way of a little bit of background, Mint Exchange is an institutional cryptocurrency exchange. Essentially what we are is a copy of what takes place in the FX markets, which is an OTC ECN layered onto the cryptocurrency world. So we are an advanced OTC ECN for crypto, where we connect to all of the major cryptocurrency exchanges, cryptocurrency market makers, and cryptocurrency and foreign exchange brokers, and allow institutions to access all of that liquidity through a single account on the ECN. Mint is headquartered in Palo Alto, California. It was founded and rolled out really out of Integral, which is a 20-year-old software company which processes about $40 billion a day in the foreign exchange markets. Masato Kikuchi, who's here today, and myself are actively involved in Mint, and we'll be around to answer questions after the presentation. So Integral itself was founded in 1993. We have about 250 institutional customers on our OTC FX market, and about 60 of those customers have now moved over onto Mint to participate in cryptocurrency trading. So for those FX brokers who have moved over into the crypto space, what are the real fundamental problems that we were trying to solve for them? First and foremost, cryptocurrency liquidity, as you probably all know, is quite fragmented. So for those brokers that are actually trading large amounts of volume, actually hedging their positions has been quite a difficult proposition. Secondly, there's been quite a lot of issues that have happened over the past few years in terms of security, putting capital at many of the up-and-coming exchanges related to hacks and basically undercapitalized institutions. The security of those digital assets, and lastly, and I think most importantly, particularly here in the European markets, is that a lot of the brokers that are offering crypto CFD products and are shifting over now to physical crypto products are being required by regulators to hedge their positions in physical markets. So for typical brokers today, they go through the exercise of linking to multiple exchanges. And as you all know, in the crypto space, exchange technology is relatively limited, it's brittle, it's fragmented. People use RESTful APIs and a number of other bespoke technologies. So it's quite a technology undertaking for a lot of these brokers to link and open multiple accounts and multiple exchanges. So when we look at the broker universe, who are the primary sponsors of Mint, as a group, they're all going through the same exercise and linking to all of the exchanges independently. And so when we're talking about 50 or 60 brokers, it's actually quite a lot of technology work going on behind the scenes. Mint's proposition to all of them was to use a single coordinated facility to access consolidated liquidity across all of the exchanges and have consolidated credit, keeping their capital in a single location. In FX markets, this was accomplished over the years with the use of aggregators and prime brokers, and since these didn't exist in crypto, we came together with the major brokers and formed Mint to specifically offer this as a combined service offering. So for brokers in the market today, using Mint, they can access liquidity, the technology, and the credit in a single offering. And it's really been quite fundamentally differentiating for them to be able to do that. The liquidity access via Mint, given that it's now connected to 22 exchanges, 6 market makers, and will eventually be connected to upwards of 35 brokers, now provides the deepest liquidity pool available in the crypto market. The technology is state-of-the-art FX technology that's been moved over to crypto. So it's all using cross-connected fixed connectivity in 3 data centers co-located with or housed in Equinix facilities in New York, London, and Tokyo. We have extremely high uptime, and we now run the operation 24/7. The credit is centralized through the Mint Exchange Prime Broker, and brokers themselves maintain all of their relationships with their customers. So Mint is purely a platform to service the brokers. So an example of how deep the liquidity is, so this is a live shot that we actually have running over at the stand of the Bitcoin market from this morning as London was opening up and Asia was just closing. And you can see, a couple of things which are quite interesting. First of all, the tightness of the spread towards the top of the book for a fully what we call a fully loaded price. So this includes all of the fees associated with connecting to all of the exchanges. So if you think the typical exchange has anywhere between a 5 and 20 basis point spread on it, which with Bitcoin at $13,000 represents anywhere between 20 and upwards of $50 between a bid-offer spread after you pay commissions. Seeing a bid-offer spread anywhere between $2 and $10 is the lowest cost for top of book in the crypto market. That combined with, within about 25 or 30 basis points, people can access upwards of 100 to 200 Bitcoins. It's by far the deepest and the tightest liquidity in the crypto market. So the next phase of Mint is actually using these same microstructure technologies to allow the broker sponsors behind the exchange to start trading with each other. So this has already started in certain parts of Asia, and we expect through a Malta regulated entity which is launching in Europe to extend this access to European brokers. The brokers are now able to offset liquidity with each other. So they can do this in the open market, they can do this in proprietary links amongst the brokers, and they can also do this through midpoint matching engines. So the brokers are now actually able to take their B-books of their crypto risk that was generated either via CFD or via physical assets and actually offset them against each other at extremely low costs. In most cases, it's purely just the cost of accessing the exchange. There is zero bid offer spread because they match off against each other at the midpoint. So we're currently offering access to 5 major cryptocurrency pairs against US dollar and Japanese yen, and crypto against crypto. We're expanding these pairs by the end of this month to include now EOS, Stellar, and I think there may be 1 or 2 others, but it sort of rolls out with the regulatory regimes in the various jurisdictions that we're serving customers. So Mint today is live. It's been live since January. We're now running the operation 24/7 every day of the year, so it's always running. Mint Exchange actually acts as the counterparty to all trades. In the EU, for brokers in Europe, they execute against a Malta FSA regulated entity, and all of the technical support is provided by Integral, who is an affiliate of Mint, support offices in New York, London, Tokyo, and Singapore. So with that, I would invite you all as institutional players to sort of solve your liquidity, credit, and technology problems by partnering with Mint. You'll find that the technology is significantly ahead of where the current crypto market is today. We will actually answer a telephone call. We will actually walk you through sorting out your issues and your problems of maintaining your technical links. The liquidity really is head and shoulders above what people are getting from typical crypto exchanges. And as a US entity and running regulated entities around the world, we're an extremely secure, reputable institution. So we invite you to reach out to us. We're happy to talk about our experiences so far, and we are inviting market participation to engage with us and expand the platform going forward. So with that, I'd be happy to take any questions and invite you to come by our booth and take a look at the liquidity and get into any more specifics you may have. So the question that was asked was how we deal with the latency with the cryptocurrency exchanges. Is that right? So first of all, there's no easy answer. We run data centers in both New York, London, and Tokyo. The liquidity we're sourcing is in cryptocurrency exchanges that also exist in all 3 centers. So Kraken, Coinbase is in the United States. OK coin, OKEX is in Asia. A number of the exchanges are in Europe. Wherever we were in the world, there's going to be some latency accessing the exchanges, so there's no way around that. What I will say is this: we are overlaying Integral's existing infrastructure that has high-speed proprietary links between the 3 Equinix data centers around the world. So first and foremost, wherever you are in the world, you connect to the closest point of presence on the Integral network. So if you're a European customer, you'd be connecting into Equinix LD4, and from there, the systems actually will give you basically the most direct access you can get to the liquidity wherever it is. One thing I haven't mentioned in here is that in accessing the exchange, all institutional exchange participants have access to Integral's execution management services layer on top of the exchange. So you can use, free of charge, very sophisticated algorithmic trading of resting your orders within the exchange, running time-weighted average price, TWAP algorithms across the various liquidity pools around the world. You can leave your interest within dark book midpoint matching engines that exist within the network. So, given the fact that the liquidity is fragmented and it does exist all over the world, this is essentially the best solution you can have to solve that problem, and it's offered essentially as a service to you. I mean, Mint is, for all intents and purposes, an OTC trading operation offered as a service, right? So we call it an exchange, but it's not just an. I think they're trying to kick me out, but I'm going to keep going because it. Did that answer your question?
The user gets to choose this, so I can pull out.
Yeah, go ahead.
So it's up to the end user to pull in, pull out different liquidity, or is it more Mint Exchange doing that? Because you want to punish people that are lagging orders to pick up trades.
So the question is it up to the user to have to configure the exchange for their use? And the answer is, you can do either. You can actually just ask the Mint engines to do their best on an automated basis to execute your orders for you and service it given the liquidity that's out there in the market. Or you can particularly program the engines to do exactly what you want to do. And so depending on the sophistication, people are doing it at both levels. And that's the one answer. The second thing is that market makers are now actively engaging in the system. And the major market makers are now coming and co-locating in our main data centers and offering liquidity directly up to users. So for example, major Asian foreign exchange brokers who are now getting into crypto are steering all of their customers' orders in through the Mint network. So market makers who want to realize the spread on that, to make markets in there, are just co-locating next to our Tokyo data center, making bid offer prices, and as those orders are coming in, they're immediately matching them with virtually no latency. So it solves the latency problem because they're internalizing the risk. And it really outsources from the customer's perspective, that execution issue. So when you combine access to other exchanges, access to market makers who are going to co-locate and make prices in those exchanges, and access to resting liquidity from other major market participants, brokers who are saying, hey, I have a warehouse, I have an AX, I want to put it in the market, either hidden or lit, and if another customer comes and executes against that, we can offset against each other. When you combine the three of those within a single environment, the execution is just significantly better than what you would get if you had to try to solve those problems yourselves, right? So that's it. But I'd be happy to talk to you offline and we can show it to you. Anybody else have any questions? Okay, very good. Thank you very much.